Good morning, everybody, and welcome to your monthly edition of the Balanced Perspective. As usual, I'm your host, David Levinson of Ned Group Investments, and we welcome Ian Power, the CIO of Truffle Asset Management, on the line this morning from Joburg. Ian, as always, thanks so much for joining us.
Morning, David, and good morning to everyone who's on the call.
And after every call, we have the QR code that pops up, and we really appreciate the feedback you guys have been giving us over the course of the last 11 or 12 months or so. And we take that feedback on board. We adjust these sessions, the format, as well as the discussion topics that we put forward to Ian based on the feedback from yourselves. So a lot of gratitude from us to you. Also, I realize it's school holidays at the moment, so appreciate everybody that has dialed in, and apologies if you do get in trouble with your family for stepping to the desk during this precious family time. As I mentioned, it is the 10-year anniversary of the fund. The invite did speak a little bit to the proud performance of the fund, ranking second in the peer category group over the course of the last decade, which I think is real testament to Ian and the team at Truffle Asset Management. But there is a lot of stories that go behind these numbers, and during the course of today's session, which will be an extended 30-minute session, we're going to try to tease out some of that fantastic information from Ian. Before I do bring you into the conversation, I hope you can humor me, and I'd like to make us all feel a little bit older and remind us how quickly time flies, and just talk about what happened 10 years ago in 2011. So I was living in London. The Putney High Street shops were all boarded up as the London riots and looting had begun. Quite similar scenes to what we saw here in South Africa back in July. The Arab Spring kicked off in 2011 as well, and we saw regime changes in Tunisia, Egypt, and Libya most notably. Then moving on sort of far east, Kim Jong-un took over from his father. Also in the communist world, Fidel Castro handed over the reins to his brother. But it wasn't just communism that came under the microscope a bit. It was a testing time for capitalism. I remember in London, the tents parked outside the Square Mile there, as well as the Times, or not the Times Square, at least Wall Street in New York, as people were very disgruntled with the capitalist system and the investment banks post the 2008-2009 financial crisis. In terms of some weather, or at least environmental events of that time, there were the earthquakes that affected Christchurch in New Zealand. Another earthquake caused the tsunami and the Fukushima nuclear energy disaster, which I think was the second biggest disaster in nuclear energy's lifetime. And probably on a more positive note, a little-known show known as the Game of Thrones began its first season on Netflix in 2011. But of course, South Africa had its own issues. We were undergoing the meat of the Zuma years during the course of the last 10 years. And this is where I think I'd really like to bring Ian in here, because we obviously experienced things such as Nenegate, state capture, and the Guptas. So putting on our backward cap before we put on our future forward-looking lens, Ian, some of the lessons that you learned over the course of the last decade, and maybe something specifically more to stocks.
Oh, thanks, David. I think, reflecting on the last 10 years, we've been in this environment where since Zuma took over, that South Africa effectively dislocated from the median country around the world, and our growth progressively moved lower. And I think, as the corruption and the state capture I guess got more and more entrenched, so did our growth trajectory decline. And I think obviously that had a big impact on many of our companies listed on the market. No doubt that, that had a big role to play in terms of some of the returns looking back over the last 10 years of some of the sectors and some of the stocks. But I think one of the big lessons that we learned looking back over the last 10 years is that when you are faced with two opportunities or two securities that have the same level of upside or expected return, if they both have sort of 35% upside, always defer or always choose the better business, the business which has a higher return on invested capital, the business which has a stronger moat, which can see it through difficult times, good times, because as we all know, it is very difficult to predict the future. And I think 10 years ago, back in 2008, 2009, after the GFC, it would have been very difficult to predict where we would have ended up today. So I think, that lesson of always choosing the better company, the more solid business, rather than the average or below average business, irrespective of how cheap it is, will typically stand you in good stead over time. Obviously, you must be paying the right price for that asset. But, what we've seen is that lots of businesses which optically look cheap are cheap for a good reason. And it really takes good analysis to discern between what is a value trap and what is a true value opportunity.
Thanks, Ian. And I think the right price also speaks to the cyclicality nature of the markets. And it's been quite an interesting decade in terms of what the cycles have done. Have you taken any lessons from that?
Yeah, so I think from a cyclical perspective, what's very important, and obviously from an SA perspective, even more important, given that cyclicals or resources make up a huge percentage of our market, is you've got to really understand where you are in the cycle and what a company or a resource company is earning today versus what its sustainable earnings or returns are through the cycle. So if one just takes an example of Kumba, 2 months ago, the iron ore price was sort of $220 a ton, and they were certainly earning north of that, given the quality of their product. But we all, or certainly Truffle, has been concerned or had been concerned about the level of the iron ore price for quite some time, because the cash cost of some of the big producers, believe it or not, is closer to $20 a ton. So these guys were making super returns, and it's just a question of time before some additional supply came on the market. So if you were buying into Kumba's current earnings with the expectation that they were going to continue to grow off that level, you would be sadly disappointed and potentially would lose a lot of capital. So the important thing that we do from a Truffle perspective is understand what is the normalized or sustainable return or set of cash flows for that business. Then understand where is that business today relative to that, to get a sense of what is the right price to pay for those earnings. It doesn't matter if the company's not earning earnings or return today, if it's a cyclical company, because it means that those earnings are way below average and will probably rise, but it just informs you or helps you pay the right price. And that would be like the PGM sector 3 or 4 years ago, where we got involved with many of these shares which were trading, Impala Platts was trading closer to 20 Rand a share, got as high as 260, 270 Rand a share. So I think you've got to have a sense of where you are in the cycle and where the risks are in terms of the earnings and the rating. And I think that's a big lesson and a very important principle to understand when you're buying cyclical assets. Mm.
And I imagine choosing that moment can also be quite error-prone. And when we look at the performance of the fund, it obviously looks very impressive and quite smooth at certain times. The fund's had its triumphs, but I guess it's also had its tough periods as well. So I guess it talks a little bit to mistakes and learning from that. Is that a fair comment?
I think that's right. And I think if we look back to Brexit, I think to the extent that when things change or when the facts change, you need to be able to change your mind. And, I think one of the big advantages that you can give to your returns and your clients is not to be dogmatic. And when your investment thesis or your investment case looks like it's wrong, in other words, the experience that you're seeing is different to your base assumptions, you should reflect on that and have the intellectual honesty to admit that you've made a mistake and then cut the position. So, we have a view at Truffle that every day is a new day, and there are no holy cows. We're not going to nurse positions that are wrong and would rather cut that position where you can then redeploy that capital into an idea where you have a higher probability of actually achieving that target return. And I think that's where many managers fail, is their inability to deal with their mistakes and their inability to cut those positions from their portfolios.
I think those are some very valid points, because when we do look at the performance of the fund, like I said, it's obviously done really nicely for clients. there's maybe one or two periods where you think, okay, it's kind of performed a little bit more in line with the market, and that was around the period of Brexit. And I remember that it was quite a curious year. I think it was 2016, so almost exactly halfway through the lifetime of the fund. Trump got voted in, which surprised everybody. We all woke up on the morning of the Brexit vote and maybe wasn't the result we were all expecting. We kind of hoped some sort of common sense would prevail. But I think you're right. It's about learning those lessons, adapting after those mistakes, but keeping within the rigorous realms of your own process as well. You mentioned a little bit about leveraging your team. How important has your team been? Because I say the team behind you, but they're probably the team alongside you. You have a very stable team, quite a diverse team, and that's just along demographic as well as thinking lines. I mean, is that something that really over the last 10 years, I imagine you're quite proud of?
Yeah, so I think Truffle has really spent a lot of time in terms of developing our own talent, and we think we have a very, very strong bench. And it very much is a team approach. And the team approach comes in that the team is able to interrogate all the ideas before they go into client portfolios, and giving the clients the benefit of the multi-decade experience that many of our team members have, up to some of the team members closer to 4 decades. But the reality is we want to test the ideas in the furnaces of a robust debate, because at the end of the day, if those ideas can successfully emerge from the debate unscathed, it really just is better in terms of increasing probabilities of achieving the real returns that we're after, as well as potentially highlighting some of the downside risks, which we spend a lot of time thinking about if we're wrong in our base case hypothesis, what are those potential outcomes? So I think, for us, a lot of value coming from the team debate and from opening up the ideas to rigorous scrutiny and interrogation from everyone in the team, and that also provides a nice learning environment for some of the younger investment professionals coming into the business.
Thanks, Ian. And I think that old adage always comes through when I chat to yourself and the team, is you don't bet the farm. A lot of focus on the downside potential of a potential stock or something that might be on your buy list. So really looking at the downside. I remember we chatted once about Bitcoin, and you brought up the idea saying, David, I'm running a Reg 28 pension fund. Yeah, this is people's retirement money. And my number one goal is not to lose clients' money and generate something that remains attractive for them in the fund as well. I want to move a little bit more forward now in terms of how you see the future playing out. These are some very big questions, big sky thinking. We currently had our international summit, I think it was about 3 weeks ago, where a poll was posted to the audience on what they view as some of the big thematics to play out. And I'll read this out for you at least to play out in the future. There was AI and big data, sustainability got a lot of attention and votes from the audience. There was blockchain, spoke a little bit about Bitcoin as well, and the aggressive growth in e-commerce. But I just want to get a sense from you. I know you did send me an email with some of the rough ideas in terms of your big themes playing out, and there was a big sustainability focus, which, as you know, as the champion of responsible investment in Neg Group, I was very excited about. But I think the first one you mentioned was how the world will pivot to sustainable energy. Maybe you can give us a little bit more color on that.
Yeah, so I think what we're seeing right now is a very, very strong shift, and not just in certain parts of the world, but pretty much everywhere, where there's a very stark recognition by governments, particularly some of the larger governments, insofar as the impact of global warming. And if we don't reduce greenhouse gases, what those long-term dire consequences look like. And I think those consequences are severe for businesses, for shareholder returns, as well as for us as human beings living on the planet. So I think the pivot towards sustainable energy is one of those mechanisms to try and deal with the greenhouse gas and the increasing temperature of the planet. And I think we really have reached the tipping point when we look at just, for example, taking the electric vehicle space. And if you look at the the big auto manufacturers, whether they be a Daimler, Volvo, BMW, Ford, every single one of them are reconfiguring their drivetrains for EV engines. And in many cases, certainly in Europe, many of these OEMs are going to stop manufacturing internal combustion engines by 2030. So if you think about that, we're going to almost the end of 2021 into 2022. That's 2030 is not that far off. And I think you're going to see a rapid acceleration in terms of the shift towards EVs. But more importantly as well, you're going to see a shift from governments, first of all, regulating, creating a regulatory framework for the shift. And then secondly, a build out of infrastructure to facilitate this move towards electric vehicles by investing in more renewable energy. And I think specifically in the storage side, which is where we think you're going to see huge investment, in addition to what we're already seeing from a wind and from a solar generation perspective. So at the moment, the sustainable energy generation is good because once it's generated, it can go into the network, but the problem is very difficult to store it. And I think that's where the big challenge is coming. And I think the vagaries of the weather in terms of wind and in terms of rainfall for hydro has really highlighted to many governments around the world that they need to have more storage so that they can manage a higher base load of the electricity supply. And this is just one of the factors that we think is currently in motion in terms of pushing the planet towards a path where we then limit the amount of greenhouse gas so that we at least stave off catastrophic climate changes insofar as global warming.
Thanks, Ian. And the sense we get from the government here is we're looking to really start ramping up that renewable program as well. And I've made the comment to you historically that I think we get the second best or one of the two best solar radiation in the world. I think it's South Africa and Australia for solar power conversion. But I think that battery storage will be a complete game changer for the renewable space as well. And I'm glad that you mentioned electric vehicles. I think Biden is targeting 50% of all new vehicles to be electric by 2030. Typically South African investors, or at least within your fund, you do have an offshore component, so there is some sort of exposure. You can get some of those technologies, but locally it's more about the type of minerals and resources that one can gain access to be part of that energy transition.
Yeah, I think that's right. And I think, if we look domestically, one of the benefits that South Africa has, or its competitive advantage, is that we are resource or rich or mineral rich in the sense of metals. So I think, to the extent that we have PGMs, or there's a lot of, PGMs, which we have nickel, we have copper, so we certainly have many of these new age or battery metals. And I think that you are going to see a long-term structural increase in terms of the demand for many of these metals as this transition and shift takes place. So I think, the opportunities in terms of what the internal combustion engines will lose, there's obviously other places to benefit from the increasing spend that we're likely to see, not just from a production point of view, as I said, but also from an infrastructure point of view. You have to build charging stations. You need cables to get more power to the charging stations. And, obviously there's a whole logistics infrastructure that needs to be created to be able to support this. So from the generation side, all the way to the transformers, to the distribution, to the charging stations, this is a huge shift that will take place. And, no doubt there will be trillions of dollars that's going to be spent on this over the next 2 decades.
So talking about that investment into green tech, I think the US just had their debt ceiling usual debate, which seems to stall Congress there and any public servant for a few days. But I know Biden did put through a proposal for, I think it was $50 billion to roll out their EV charging stations. I think it went through Senate or Congress. I can never remember the order. It got down to 12, and eventually I think $7 billion might have been signed off over the weekend. I do stand to be corrected. So they're looking to roll out a little bit more aggressively. those sort of wheels of motion and change here in South Africa may be a little bit slower. But the optimist in us hopes that by 2030 we can go on a similar journey. So you did highlight climate risk, and there is the COP meeting in Glasgow. I think that's next month. They talk a lot about climate change mitigation and adaptation, and with that comes a lot of investment in the green space. And I guess that talks quite significantly to what you've just spoken about over the course of the last 5 minutes. But I wanted to maybe think this could be a nice segue into one of the other themes you highlighted, which was ESG in investing. So we've given a little bit of the background, but there's obviously an impact to us as investors and fund managers as well, also on the regulatory side. So as a theme that you highlighted, maybe you could give us some sort of insight into that.
Yeah, so I think from an ESG point of view, really what we're seeing is many of the targets now being legislated by governments and regulators around the world. First of all, in terms of sustainable usage of raw materials, and then secondly, in terms of emissions. And I think what this is going to do is it's going to really bring a two-pronged approach to bring about change in terms of the way businesses operate. So the one is, from a stick point of view, where regulators are going to set limits where companies must comply. And we're pretty sure that if you're in, some of the developed world where the legal system and the process of law is still fairly efficient, that companies will make the adjustments. If they don't, they're going to be hit with carbon penalties, which are going to get more and more expensive. So you will see companies start to change, but it doesn't end there, because what the developed world is looking to do is to then potentially penalize other companies around the world which don't meet those same greenhouse gas or best of breed criteria. So what you're likely then to see is a import tax, some sort of a tax that is then applied to the dirty producers of product to effectively level the playing field for domestic producers who are then adhering and meeting the various emission standards. So I think the penalties for these dirty producers and dirty countries are going to start to rise, and that's going to put pressure on their regulators as well as the shareholders of those companies to force these businesses to get their act in order. And that pressure is starting to build. And we've seen cases, and we've seen, for example, in Europe, where shareholders have taken some of the oil companies to court, and that pressure is going to build. Together with the fact that you're going to have the regulators actually set targets in terms of what these companies have to meet. Then, of course, there's the carrot side of it, where I think companies which are able to transform and to get their emissions and their business model more sustainable insofar as the goals are going to be rewarded, to the extent that investors are looking for businesses which can be more sustainable in their models, and those companies are likely to find support from shareholders. And typically, if you hold a portfolio of companies over time, and many of these companies have below average ESG scores, the longer you hold them, the higher the likelihood that one of those risks will manifest. So I think there's also, common sense, in the sense that we want to invest in businesses where those tail risks are lower, and where they're effectively being better stewards of the assets and the resources that they use to either produce their goods or services. And if it's a service, that they're paying their workers an appropriate wage, that the workers are getting social service benefits, that they're not being overworked. All of these things are important in terms of creating a sustainable environment, rather than extracting, unnecessary gains from, either it be the resources or your labor, etc. So I think we're seeing that change, and we're seeing the regulations come. And in the long term, this will be a good thing, as it makes for more sustainable business practices and a better place for us humans to live.
Thanks, Ian. Yeah, no, our colleagues in the UK are constantly being pressured in terms of the SFDR they have there, or the Sustainable Finance Disclosure Regulation. So funds are now having to incorporate ESG. It's no longer just that nice to have, but is almost a ticket to the game now. And I think we might start seeing that in South Africa down the line as well, as ESG starts to cement itself. But I have to give a caveat to my colleagues who have dialed in today, because I'm constantly drumming the ESG beat. But these were Ian's 3 themes, not mine, although he does know a way to my heart. But moving off the ESG and sustainability topic, another one that you mentioned to me was around long duration assets. I know we have only a few minutes left, but maybe just your thoughts on that and what you meant by that.
Yeah, so I think, David, many of our investors will know that our portfolio, and from a risk point of view, one of the issues that we've been increasingly worried about is the potential risks in expensively priced long duration assets, whether they be fixed income or equities. And we think the shift in terms of interest rates and interest rate expectations and inflation expectations is underway. And the risks to those long duration assets, we think, is very high. So from a portfolio point of view, what we've tried to do is structure the fund in a way where we really are underweight or have no exposure to these expensive long duration assets, because we think this space where there's a lot of money, there's a lot of crowded capital chasing some of these stocks, we think that there is the potential for permanent capital loss. And I think, as I said earlier, one of the issues which we focus religiously on is not to overpay for assets. And we think many of these assets are expensive, and investors should be reducing their exposures to many of those assets. So we think that's some value that we can already give back to our clients and the investors, is the fact that you're not gonna, there's no probability of losing a lot of money on those long duration assets, because we've exited many of those positions already and focused more on the positions where which we think will benefit from the environment that we're moving into.
Thanks, Ian. I wasn't sure whether to go down this road, but I think it was about 15 years ago, if not more, Jim O'Neill, an economist at Goldman's, coined the term BRIC. We managed to somehow bump a car our way in to be an S on the end, but he never intended that. I think it was just Brazil, Russia, India, and China. It's that final letter there, the C, that I want to kind of focus my last question on. We spoke a little bit at decent length about China last month, but what we've seen, in your view, is that a permanent shift on the investment proposition there?
I think that's right, David. I think what we're seeing in China is a structural change in terms of policy and policy direction, where the government is looking for more inclusive growth and to narrow the wealth gap between the very wealthy and the very poor. And it might be a surprise to some of our investors and some of the listeners on the call that there are 600 million Chinese people who live on less than $145 a month. And clearly that is not sustainable. To the extent that you've got very, very wealthy people, and these poor people are not able to, get a proper education or get onto the property ladder or be able to put themselves in a position where they can improve their circumstances. So I think a lot of the regulatory changes that we've started to see in China are steps from a government point of view to try and put in place a framework to facilitate the closing of that gap. And to reduce anti-competitive practices, to effectively level the playing field, and at least try and help many of these citizens to educate their children to the extent that it's not very, very expensive to do, and then also enable them to be able to buy a house. And as many of you guys would know, that the Chinese property markets is one of the most expensive in the world when you look at the cost of that property relative to the average income. So I think a lot of these steps, if they can achieve them in the long run, will be good, because it will make it more sustainable and create a much bigger middle class. The risk, however, is in the implementation, and I think this is where China is very different from the Western world. The Western world, things do change and laws are passed, but you have a strong lobby system. There's a whole process where all the parties are allowed to reflect on the proposed changes and come back with suggestions. This doesn't happen in China. China implements it overnight. And of course, that has caused a lot of uncertainty and a lot of angst. And rightly so, because many of these changes that we've seen across lots of these Chinese businesses will have the impact of reducing the earnings power of some of these businesses. And secondly, investors, given the changes and the uncertainty, are going to require additional margin of safety or a higher risk premium to invest in these assets. So, we wouldn't be surprised in the short term to see more weakness in the Chinese market, especially once many of these companies start to report their earnings, which we think are probably going to disappoint. But over the next 20 years, we think that the long-term growth of China and the rising GDP per capita of their incomes in terms of the individuals will still create lots of opportunities. But in the short term, it's probably sensible to be a little bit cautious and then wait for some opportunities to arise on the back of what we think was likely to be some further weakness.
Great, thanks, Ian. I think you're right there. The Chinese Communist Party is not tied up in that same bureaucracy that we see in the Western world. And when the needle requires moving, they're able to do so relatively quickly, like you say, over the weekend on a cup of tea. But even this extended 30-minute version absolutely flew by. We probably could have gone on for way longer. I know I've been very absorbed in what you had to say, but I think I speak on behalf of myself and my colleagues and the clients have dialed in there. Thank you so much for the last 10 years. We really appreciate the work that you and the team are doing there. And please do relay that message. And when we do see you again in Cape Town, when travel is back to being a normal thing, hopefully we can share these calls in person and over a cup of coffee. But thanks very much, Ian.
Thanks, David, and thanks to all the investors and everyone who signed in for this morning's call.
Fantastic. Phew. There was quite a lot to take there compared to our usual week. So I was scribbling away, as become characteristic of me. So to just give a really quick highlights package of some of the comments that Ian came through in terms of his lessons. When two stocks are quite similar, what they look for is the better business or the better quality business. In terms of the cyclical stocks, make sure you don't overpay. And when you do make a mistake as a fund manager, it's important to be honest with yourself. And in terms of the fund generating top quartile returns over the last decade, it's not just about picking those winners, but avoiding the losers as well. And then I really like this comment from Ian here. I've put it in inverted commas, is every day is a new day. So be flexible in your thinking. And I really like the team that Ian has around him as well as they rebound ideas off one another. And then when we look forward to the future, some of the key themes Ian picked up on, and like I mentioned, this was not my influence whatsoever, but 3 in the sustainability realm. And the first one was the energy transition to a greener energy economy, the risks and the physical risks of climate change. As the COP meeting takes place in Glasgow next month, this will start to realize a lot of release of capital in climate change adaptation and mitigation, which offers investment opportunity as well. And that speaks a little bit to the ESG trend that we're seeing in the investment space, as not just clients but regulators are starting to demand more of fund managers in the sustainability arena. And then a little bit more off the sustainability space, Ian mentioned about not necessarily avoiding but managing long duration assets will be something quite pertinent given where yields currently are. And then China, we spoke about it fairly at length last month, but yeah, it's remains to be seen whether we have this permanent shift, but Ian did sound rather cautious over the short term, but quite optimistic on the country if you look at that population and as that middle class begins to grow there over the next few decades. I'm not sure I covered it all. I most certainly tried, but thanks as always from myself for joining us this morning. For those of you that have dialed in from your school holiday, really appreciate it. It was a longer session, so for any of your colleagues that aren't in, that are on leave, as usual, this will be recorded, so do get in touch with your Near Group Investments relationship manager and they can send you on the link. All the past previous 11 editions of the Balanced Perspective are also available online should you wish to see them. So I am short of breath from myself, David, Ian and Joburg and the rest of the Near Group Investments team. Thanks as always for joining us, and look out for the Balanced 10-year celebrations and all the notices coming out over the course of the next month. Thank you very much.